back, everyone, to Lamb's Cryptoverse. Today, we're going to talk about the Tesla Robotaxi because, as everyone knows, there's a big October event from Tesla that's going to introduce the Robotaxi, finally, because it's been delayed. So we're going to talk about the financial model. Just so you know, there are no Wall Street firms other than ARK Invest, and I'm not even sure if that's really considered a Wall Street firm, because they're like an asset manager for ETFs. There are no financial models other than probably the one I'm showing you now on this slide that talk about a robotaxi in the future. Like, what could Tesla get out of it in terms of revenues and cash flow, things like that, and how's it made? I include all the drivers. One of my points in doing this model, because I did a lot of research, I looked into Lyft and Uber, and I looked into ARK Invest model, and I listened to Adam Jonas and some specialists on Tesla that are on YouTube, like Invest Answers and people like that, and Hans Nelson, and Farzad. So there are quite a few people that follow Tesla, but most of them don't have financial models. And what I try to do is simplify. I like to keep things simple. Just like Elon Musk, he uses the basic, simple, basic principles model. And so that's what I try to do. I only have basically a few lines that expresses everything for the financial model. So let's go. After this, I'm going to talk quickly, and I encourage you to stop the slide and then take pictures. And you need to know about Tesla before you watch this video, because I'm going to be talking about the company quickly. So let's get started. So the first slide here is on what's going on with Tesla. Like I said, you need to know Tesla. Tesla, over the last at least 6 months, is having problems along with the whole EV industry. It's not selling cars as quickly as it did before. So everyone is bearish, including myself, short term. Unit sales are decelerating. Average ASPs, as they call them, average selling prices, are going down. The pricing mix for product mix for Tesla, especially if you exclude the Cybertruck, is not good. No one's buying the big SUV, the Model X. No one's buying the Model S. And there aren't many people buying the Plaid. They're very expensive. So average selling prices are going down. Cash flow has been negative this year. There's a lack of new core models. And people are fed up with Elon Musk, with his rants. And you could take a look at these charts later, but it just shows you that inventories are going up quickly for electric vehicles, and people are not buying electric vehicles. They're buying hybrids and ICE cars, internal combustion engine. Financial summary, again, I'm going to talk about this quickly. They're not doing too well. This is the last quarter for June. Again, they're not doing well. Revenues hardly went up like 2%, and only because of the energy division, which is doing really well because of those commercial mega packs. Let's just leave it at that, and you could look at this later on your own. So Tesla's position. People don't realize this, but Tesla's in a very strong position in terms of their business position within an industry structure. And this is a framework that was created by Michael Porter over at Harvard Business School, I believe. And I'm not going to spend much time on this. You could read this on your own. You could get his book and read about it. But here's where Tesla is very strong. And I think they have a unique position within, not just within the automobile industry, but within EVs. So I'm going to talk about it quickly. Again, they're a low-cost producer, not just low cost per se, but a low-cost mass producer, meaning they can produce a lot of cars and maybe even robots in the future quickly and easily, so they can scale up. There are very few companies in the world that can do that. Weak new entrants. By that I mean electric vehicle companies like Lucid and Rivian. They're all having financial problems. I mean, recently, was it Lucid? No, Rivian received $1 billion or so from Volkswagen because they have expertise in electric wiring systems, for example. But the point is that most of these companies are having problems. I'm just thinking of another one, like Polestar and Faraday. A lot of them are having problems. Let me continue proceeding, I should say. vertical integration. Tesla is vertically integrated. Now, that's usually not a good thing, but when you're entering new markets, you want to be vertically integrated because you need to know how to harmonize and have all these products and hardware and software all work well together. Doesn't this remind you of the iPhone and Steve Jobs? Or it reminds me of that. What else? There's low threats of entry because there's so many companies already in it and that are having problems scaling EVs. And speaking of problems, these big companies like Volkswagen and General Motors and Ford are having problems with their initiatives in the EV space. And I'm not going to talk to you about this now because I did a video on that previously and I wrote some articles about that on Seeking Alpha. But basically, they were aggressive on paper, but like Elon Musk says, it's easy to design something, but where it's very difficult is execution, specifically mass execution. Okay, next slide. Okay, here, basically this is talking about, and it's not written here, the double flywheel effect. Basically, ARK Invest is saying that there's a strong case for Robotaxi because if you combine neural networks, and neural networks basically AI, you're combining AI with advanced battery technologies. And as you know, or should know, that Tesla is one of the leaders along with QuantumScape and solid state and BYD. And Tesla is leading with the 4680. That's a new battery technology. So these new battery technologies have big advantages. And one of them is lowering operating costs. And so when you combine neural networks / AI with advanced battery technology, and I'm going to add a third one because battery technology is the number one cost for a car to produce an EV, but there are other large costs like producing the sheet metal and the whole structure and the skateboard of the car. That's expensive too, and the electronics and the autonomous electronics and the entertainment center. These are big cost centers. And you combine all of those costs going down quickly, then autonomous mobility, also known as Robotaxi, is something that is foreseeable in the near future. Okay, what's the TAM for the Robotaxi? So I think we're about 120 billion right now for the conventional ride-hailing industry. And that's probably in the United States, actually. And if you want to, yeah, that's for the United States. And usually what you want to do is double that. If you're looking at any industry, usually you could like double it, and that's globally. So let's say we're about 250 now globally for ride-hailing. Uber, this is from Uber Technologies, by the way. Uber Technologies about, I think it's 2 years ago, they had an investor day. And in that investor day, they had the slide in terms of the investor pack. And this one slide said that the U.S. opportunity alone, just in the U.S., the opportunity for Robotaxi, as I'm calling it, is in excess of $1 trillion. I mean, that is unbelievable. And that's if the price of the charge per mile that the ride-hailing company is going to charge you, if it goes down to a $1 per mile, you're going to get that switch, that hockey stick increase in revenues because there's an elasticity of demand. So there's more demand as price goes down. And now, then the next slide, I'm going to show you another TAM. And this is from ARK Invest, this next slide. Now, ARK Invest is given even crazier numbers. They're saying that on the left side here, they're saying that the existing market is 130 billion, but they're saying it could go way up to $5 trillion, not billion, $5 trillion by 2030. That's only 6 years from now. And they're saying in Western markets, which include the United States, that it could be $1 trillion. So what I like, and the reason I showed you the slide, it concurs and agrees with what Uber Technologies is saying, because Uber also mentioned that $1 trillion number. So we're talking about a huge TAM. Next, so what financial model would or could Tesla use? So Elon Musk said that on their wish list, they didn't say wish list, their plan is to have their customers. Elon said he wants his customers to be executing this, to be lending cars for the Robotaxi. But I hate to tell you, this ain't happening because they're not there technologically yet. So the model that they're going to use, in my opinion, is Tesla-only cars for now. Because right now, Tesla only has what's called SAE, or let's just call it ADAS, ADAS, level 2. Level 2 must have human supervised autonomous, meaning you need a human. And remember, if you have a human like Uber, you're only getting 25% of those gross revenues. Humans are very expensive, right? So that's going to be an issue, and that's in my model. So I'm not going to talk about these other models, but I think in the future, we're probably going to have a JV or something with Uber, or maybe a JV with Uber, a joint venture. Okay, so let's talk about my financial model, because this is what I was going to say, most important, or the crux of my presentation. There's a lot to talk about. I'm going to talk about it quickly, and I'm going to use some notes here. So the first one is Robotaxi production. I think that what's called ADAS level 4, level 5, meaning autonomous, is not going to be for a while, maybe not until 2027. That's A, and that's going to show, that's going to be a footnote on my, I don't know if you can see this. I'm going to show a slide like this, and there's going to be a letter next to it that says Robotaxi growth or production, number of trips. And I'm going to show you that soon, but I want to talk about this first. I want to get you comfortable with the assumptions before I actually show you my slide. So the second one is number of trips. I could spend an hour on this. The point is I've chosen 19 trips per day. Other analysts like ARK Invest have chosen much higher trips, but that does not make sense because the number of trips is limited by several factors, like miles per trip. If one trip theoretically is 1,000 miles, there's no way you can do 19 trips per day. Just think about it. The same thing with the speed. If you're doing, let's continue with that. You're doing one trip for 1,000 miles. Unless you're going like 1,000,000 miles an hour, you're limited by speed. And because you're limited by speed, you can only do a certain amount of trips per day. And then you have to, and I'm going to go on quickly now, talk about the other points. You have to wait for the passengers. You have to load them, or they have to load themselves, and maybe they're elderly people. You have to load luggage. In my case, you got to load car seats. The cars have to wait for orders sometimes, especially in the middle of the night. You have to drive to the customers, and that takes time. That takes mileage. You have to charge the car, and you can't use quick charge and fast charging because the supercharging network that Tesla has, it has been said to create heat, and heat can deteriorate the batteries, which means it's going to be more costly to run those cars. And then you need to service those cars. You need to change the tires on the cars. The tires on EVs wear out much quicker than ICE cars because there's so much speed and torque. I don't know if you ever thought of that. Remember, tires are very expensive, and the cars have to be, like I said, serviced in other ways. They have to be cleaned. Okay, next point, C. Average trip length. I chose a blend of city and service at 7 miles per trip. Minimum charge. Remember, no matter where you go, you could be going one block. You're going to be charged a flat fee for that one block. You know, there's a charge for the infrastructure for booking the ride. There's an infrastructure cost. E, this is a little complicated. The charge per mile, which everyone refers to, and I talked to you about it earlier. At $1 per mile, we're talking about $1 trillion in total addressable market. But there's a lot that goes into that. It's affected by startup cost, infrastructure cost, human supervised drivers, as I mentioned earlier, and there's a separate charge, but I'm combining them here, a charge per minute, like in waiting time. You're waiting for the customer, you're stuck in traffic, and surge pricing was not included in my projections, by the way. F, the percent decline in charge per mile. I expect a rapid decline. So I'm starting with a high level charge per mile, but I'm expecting a rapid decline because I think production costs are going to, et cetera, are going to go down. And once we start autonomous, we won't have to pay humans to supervise a car. And then I think there's going to be ancillary revenues like advertisement, entertainment. So here's my model, my financial model. Like I said, it's very sweet and simple. I use the basic principles on this, meaning let's keep it very simple. So fiscal 2025 is only for illustration purposes. It only shows one car, so you could print this at home and look at it and see if it makes sense to you. If it doesn't make sense, put it in the comments. I'll have a look at it. We mentioned most of this. I'm just going to go over a few points quickly. The number of robotaxis are not going to pick up until 2028. Why? It's because of what I said earlier. ADAS level 4, level 5 is not going to be for a while. Despite what Elon Musk is saying, it's not going to be for a while. So they're at what's called FSD version, 12.4, 12.5. That's the shift. Level 12, FSD level 12, I should just say FSD 12, is really the first version of the AI/neural network. So it's going to take some time, even though it's much more advanced than previous versions. There's going to be some nooks and crannies that need to be fixed. But what I'm hearing now, the feedback from FSD 12.4.5 is that it's doing really well, and we're getting towards that cusp where we're getting to be 99-point-something% accurate. But remember, in autonomous EV, there's a 90-90 rule, which says, I'm trying to remember, that we're 90% of the way there to autonomous with another 90% of the way to go, meaning that last 0.1% or whatever, 1% is going to take a long time. And remember, customers, they're not going to be comfortable with cars that crash. Even if EV cars right now, autonomous cars by Tesla and Waymo have been proven to be safer than human drivers, but that's not enough. Customers are not going to be comfortable unless cars are like a plane. They simply cannot crash. I think I'm going to skip most of this and maybe just focus on one more. See my pointer. You can see charge per mile. It's high because of human supervised drivers. Then it starts going quickly down in 27, 28 because of what's called the unboxed car. That's a new way of producing cars. It's going to dramatically reduce production cost, and meaning the cost per car, the depreciation cost or expense is going to be cheap. And then, of course, it's going to be autonomous, which is going to eliminate the human driver. And remember, something I forgot to tell you, Waymo's autonomous hardware is significantly cheaper than anyone else's in the world because they only rely on optics, vision. They got rid of radar and they never used LiDAR. Elon Musk says a LiDAR is like having lots of appendices, I should say, in your body. Basically, he's saying they're useless. Here's my dividend discount model. Discounted cash flow model, not dividend. And it discounts all of my cash flows. I'm looking for, by the way, between $5 to $7 billion in a cash flow deficit from Robotaxi because of infrastructure cost, high cost for human drivers. Then it's going to be very free cash flow positive in the out years of my model. In year 15, for example, I don't have it in my notes here, but I think it's going to be like at least 17 to 18% free cash flow margin, meaning free cash flow divided by revenues are going to be 18%. What this does, it combines all those present values and it gives an intrinsic value or share price for Tesla at $240 per share, including dilution, Elon Musk's huge dilution. I included that, even though I don't think Tesla's going to be issuing many shares because they're a debt-free company. They don't need to issue equity or debt. Maybe a little equity for Elon Musk. Now, here's my key point. Two key points. The share price of Tesla right now is about $215, $220. So it's within 20%. So to me, even though my calculated share price is over the present day share price of Tesla, it's not enough. 15, 20% is not enough. But if you include the value of Robotaxi alone, you have to add that. You're adding 204 to 240. Then we're talking, then Tesla's worth $445 per share. then we're talking. But if you look at Tesla as a car company, and a lot of investors, that's how they view Tesla. They view it as a car company. Then you have to look at car company enterprise value to revenues. That's how I view all companies. I don't look at the price to book, price to earnings revenue. I look at enterprise value to revenues, especially forward revenues. But this one has enterprise value to trailing 12-month revenues. And they're showing that Tesla's EV to revenues is 6.5 versus the average of probably under 1. Let's say it's 1. So 6.5 versus 1, you do the calculation. But basically, it's if the stock price was $6.46 versus $1, it's saying that the stock price could go down from $6.46 all the way down to $1. That's a huge decline. As a matter of fact, I think Tesla I don't think it's going to go down that much. There's a lot of support at a certain level. So I think maybe it'll go down to $170 per share. Or if there's a bear market, which I think there will be, a bear market and recession, which means people are not going to be buying cars, maybe we get down to $120 per share. So it's not as bad as what this chart is showing, but I still think that Tesla shares are going to go down short term. And here's ARK Invest expected value at $2,600 a share. That is crazy, in my opinion. That's their expected value. That's not the bear case. Their bear case is $2,000 per share, which makes no sense. And why does it make no sense? They're using a Monte Carlo simulation of 45 independent assumptions, and they're using all kinds of laws. One of them is Wright's law, and this law says that costs go down at a certain rate. And as part of one of their assumptions, I'm only going to focus on one. They're saying here, the top line, despite Wright's law is saying that gross margin is going to be really high, they're saying margins are never going to be higher than 40%. To me, that makes no sense because their margins were never higher than 28%. If you look at the bottom here, the highest their margins were in 2014 at 27.57%. I'm looking for margins that are going to be very low because I think their EVs are going to be loss leaders. They're going to try and sell as many cars as possible so they can make money on of course, Robotaxi, but also they're going to try and make money on autonomous FSD because it's a subscription service, and they're trying to make something like Spotify or, you name it, Netflix. They're going to try and get those SaaS revenues, basically, like a SaaS company. Here's what I think ARK is doing. It's analogous to using the binomial stock or option pricing model. I studied to be a risk manager. And what they show you here, to predict the expected price the way ARK did, they put the highest price here and the probability of it, the highest stock price again, and the lowest stock price. And then they take a blend of the two based on the probabilities. The problem with this model and Monte Carlo simulation is that this high value of stock price or assumption can be too high because the Monte Carlo simulation is doing multiple simulations. And when you do multiple simulations, there are many simulations at this high level. And that's the problem because you don't get too many at the low level. Because think of a stock price. It can't go below zero. And most of the time, it doesn't go below 50%, but it can go above 100%. So when you add it all together with this model, the binomial option price stock option model, you get an expected value that tends to be in the middle of these two. And that's the problem with the Monte Carlo simulation. Well, that's everything, everyone. I hope you like this. Smash this button. Share this video with your friends. If you have questions, let me know. I'm also on Seeking Alpha. I write articles on Seeking Alpha. And if you have comments, comment on there or comment on here. Again, thank you very much for listening, and I hope I didn't speak too fast. Bye-bye.